To all of you, lessons learned along the way as an investor.
So I think for me, it was to be more intellectually honest with the founders. That goes a long way in building strong trust with the founders. So, even when we have to give harsh feedback to them, be intellectually honest and give candid feedback. Founders usually have very thick skin. They are used to hear no multiple times. And you will be benefiting them a lot if you tell them the real feedback, even if it is something that they will not like right now.
For me, in my career, I used to have this view that I have to find the perfect entrepreneur. As in, all qualities that I want should be there. And over time, realize actually that is not what works. What works is few spikes, and there are always going to be few gaps. But are you able to identify few spikes, and is that spike relevant for that sector? So there is sometimes a market fit that one looks for, and in hindsight, that is where I found success. Companies after companies, and there was always such a strong reason to say no. That if you don't have that conviction on the spike, you'll always say no to the founder.
As investors, when you meet entrepreneurs, do you look at, what can be the spike in it, or what can go like no or yes? Because many investors I hear say, हम सोचते हैं कि क्यों नहीं इसमें fund करें? Why we should not fund?
So I would say I need to build a positive conviction on the founder. And as I said, like when we invested in LiveSpace long time back, there were so many reasons. Not a single model exists globally of somebody building a home design company, a founder who was coming from US, who was going to be based in Singapore, building it for India.
Yeah.
Right? But he was so bold. Like his view was that come whatever my way, I will make sure it happens. He had answers to a lot of questions ahead of time. So you could see a sense that urgency to build fast and build for the customer. So that's an example where so many reasons to say no.
For me, the biggest learning is to never borrow conviction. Sometimes it is very, very tempting to follow someone else's conviction. Every single time I've done it in my career, I've lived to regret it. Often my conviction is wrong, but when it is wrong, I own that decision. When I have followed someone else's conviction, let's say a large investor is coming into a portfolio company, and for that reason alone, I choose to double down. I think it's the worst reason to put capital into a company. So the important thing is, right or wrong, follow your own conviction.
For me, I would say patience matters. To build anything meaningful in life takes time. Also, what we find often is that the early data that you get in a company can be wrong. We can be very wrong about the way we are judging founders. We can be wrong about the way we are judging markets as well. In fact, I'll give an example with Whatfix. That first 1 year of Whatfix after I had invested, story was just not going anywhere. We couldn't figure out which persona should we be selling to, at what price point should we be selling to. Just couldn't figure out, and I remember that it was my first SaaS investment as well, by the way. And I thought, this company ain't going to work. But founders and markets both surprise you. And it's just important to be patient as we are building companies.
Yeah, brilliant. Yeah. Role of money. Money, you guys are money guys. So.
Today, I am a motorcyclist. So I'll give you a motorcycle analogy about startups and money. To me, running a startup is like riding a motorcycle on a highway where trucks are zipping past you. You are at a massive disadvantage of size. You are at a massive disadvantage of momentum. But you have 2 or 3 things going for you. One, you can accelerate really fast, much faster than a truck can accelerate. In startup terms, that means you can move fast where a truck will take a long time to turn or a long time to accelerate. Second, you can maneuver in spaces that no one else can go into. So for a startup, a small market is actually good enough because you're starting from zero. So if the market is only 500 crores, that's actually good enough for you to build a business. A truck would never venture into that space because it can't fit into that space. And the third thing is actually the strength of your headlight, which is how far can you see where you're going. And money only provides you fuel to actually go where you see. That is your vision. The headlight is your vision. And money only provides you fuel. So more fuel doesn't necessarily mean you can either go faster or you can go in the right direction or you can maneuver into spaces. More money only means you can last longer. And after a certain point, it actually ceases to matter. In fact, if anything, if you got a crash with a huge tank full of petrol, you're going to burn. Whereas, with a little bit of money in the tank, you can still survive.
On a slightly contrarian note though, I think it also depends on the kind of business that you are building. Yeah. There are businesses, and particularly, for example, what I do on the enterprise side, you need the right economics from day zero. Yeah. Right? And you need to build it thoughtfully. Those kinds of businesses should need lower amount of capital. There are also kinds of businesses that by design just need higher amount of capital. And one of the things, in fact, in our founder evaluation framework we look for is a founder's fundraising ability as well. Much like different elements or inputs of building a company, including talent, ideas, etc., capital is a very important building block of making a company. And founders need to have that skill to be able to raise money as well. Of course, use it judiciously, but also don't downplay the role of money in building a company as well.
Brilliant point, because if we have to look at the last 10, 15 years, what you are saying holds so true. Yeah. And some of the large businesses outcomes that we are seeing is also the pole position. You need a lot of capital.